Well, 2012 has actually started with much better returns than what we're used to over the last few years. Now, even though that's the case, I think the same big macroeconomic issues that we're used to, sovereign debt issues in Europe, economic growth in the US, even economic growth throughout Asia, we're still faced with those today, and they're going to come back from time to time. In the market, we typically having a few good weeks, a few bad weeks, as we get knocked around by the bigger macroeconomic issues. But fundamentally, we actually continue to believe that the Australian market is still very attractively valued. You're actually getting good valuations for the long term. Corporate balance sheets are in really good shape. Free to invest cash flow is strong. Dividends are strong, and the dividend yield in the Australian market is very attractive. Because of some of the bigger macroeconomic issues we are faced with today, I think we are in for a lower growth world for a prolonged period. Now, what the market is actually saying at the moment is that because of sovereign debt issues in Europe and debt issues around the world and lower economic growth, that not only are we in a low growth world, but that all companies, all sectors, all countries are going low growth. Now, that's actually where we would disagree. We actually think that there are pockets of growth throughout the world. And what the market, because the market is in a very skeptical frame of mind, what it's actually saying at the moment is, well, we think the world is low growth, all sectors are low growth, all companies are low growth, and we're going to value those companies, those sectors, those countries in the same way. So what we've seen is real compression across all markets and sectors and companies. Whether a company is a good quality company, low quality company, high growth, low growth, pretty much all companies are trading around very similar ranges, and that goes for countries and sectors as well. And that's where we really see the great opportunities, because we do see pockets of growth, because we do identify better quality companies, stronger companies, companies that have a better strategic outlook. We think that there should be differentiation. We think there should be discernment in the market, and to us, that's really where the opportunities lie. So in a low growth world, if you can actually deliver growth, or if you can deliver yield, or even better still, if you can deliver growth and yield, you're going to be a rare asset. Those companies that can deliver yield and growth, or both, are going to be, we think, are going to be bid up by the market. They're the ones that over the long term are going to deliver investors great returns. So in Australia, we think that that's companies like Sydney Airport, Iluka, Suncorp, Telstra, Goodman Group and SEEK. We think those companies represent great value, providing you with a good yield and good growth opportunities. And we think in this environment, in a low growth world, those companies are going to deliver investors great long-term returns. Interest rates are really interesting because we are going through a transitionary phase in the Australian economy. We are going through this once in a lifetime resources boom, infrastructure boom, production boom. Now, one of the concerns, and that's all very positive for Australia, but one of the concerns has been what's called the Dutch disease. And that if resources and infrastructure and capex grow, does it destroy the rest of the economy? And I think that's really an interesting question that the government and Reserve Bank, everybody's grappling with it at the moment. We want to get the benefits, but we don't want to lose the rest of the rest of the economy. Now, I think what the federal government are also trying to do, and one way to try to get through that transition phase in the economy, is to ensure that fiscal policy is incredibly tight. So the theory goes that if we have a really tight fiscal policy, that will allow the Reserve Bank to take interest rates down more, which allows us to move through that transition phase. It keeps the Australian dollar maybe a little bit lower. We may in fact even see the A dollar start to decline a little bit more. It also helps that part of the economy that are more sensitive to interest rates and also more sensitive to the Australian dollar. So by keeping a tight fiscal policy and allowing the Reserve Bank to loosen monetary policy, that could put us in the best possible position to get through this transition phase, to still gain the benefits from the resources boom, but not destroy the rest of the economy in the process.